Good morning, everyone. I am delighted. I was telling somebody that literally for the past 2 weeks or so, oh wow, how about a little bit over here? For the last 2 weeks or so, I was just excited. I kept talking about I can't wait to get to Dallas. Because, you know, with the Salt Lake City experience that I had, having a chance to just talk to you all and get to meet you all and so forth. So I was just excited at the office in Orlando saying I get to go to another one of these things. So I'm just delighted to be here. So got to talk a little bit about what I want to talk about today. By the way, I mentioned there, with respect to that exercise, you know, wins and what you're working on and so forth, for the, you know, what is it that I want to get out of this? That was that last category, and I just simply said, I think I was talking to Ryan, I just simply said community, because this is just a phenomenal community, and just the opportunity to be able to share in that community is really just very exciting and fulfilling to me. So in any event, I'm very glad to be back and glad to talk to you all. So here's the idea. Let me, first of all, make sure that I sort of set the foundation. And there's a thing that is someplace. Where is the PowerPoint thing? Oh, is this thing here? Aha, okay, good. All right, so let me just give you just a real brief reminder. I got involved in the process. I've been representing David and Freedom Founders for some time now in terms of several years. But I got involved in the process of actually interfacing with you directly when, based upon particular security that came up, an investment security that came up, I recognized, and sort of David and Davey and Lindsay recognized, that it might be appropriate to be able to do a webinar of some type with respect to understanding how securities actually work. So we talked about 506Bs and 506Cs, and I think most of you were probably in the room. I was not. I was in Orlando, so I couldn't see you, so I had no idea who's in the room. But that was all about just simply understanding securities. And then after we had the experience with respect to securities, it also became relatively apparent that while you can understand something about securities, without really understanding fundamentally how to handle the structuring of a transaction itself, it's not very helpful to you. So the second one was about how do you structure a transaction so that you begin from the very beginning to get the deal, put the deal together and so forth, and then to be able to march it down line. And that was what the focus of the second webinar was on, which was on structuring transactions. When I was invited to come out to Salt Lake City, there was a suggestion that it would be worthwhile to talk about just general asset protection and estate planning, and if you remember up in the mountain, that was the focus of what that talk was about. But in the process, if I could just have some water, Davey or somebody, just, excuse me. And so in the process of, thank you so much. So in the, let me drink this first. Yeah, oh, and thank you. But in the process of doing that, what we also recognized, because we were very much involved at that point in putting together the Investment Review Committee, that we were going to be evaluating the different types of investments which were coming in primarily through the trusted advisors, systematizing a process to be able to bring that to your attention, and also to be able to bring that to your access. So in the context of that, it became appropriate for us to be thinking about, okay, well, let's do that. And as a matter of fact, a great deal of what you're actually going to be exposed to here is understanding what that process looks like in terms of the IRC, the submission review, the deal room for your review, and so forth. But it might also be appropriate to really understand what those underwriting criteria look like, so that from your standpoint, you have the opportunity to evaluate them yourself. So what I want you to be thinking about this session to be about is not so much that process at the IRC level, but what you're going to be thinking about when you're underwriting deals. And in underwriting, and if we just think about the language of underwriting, underwriting really is the process by which you evaluate the efficacy of a particular investment for yourself. So when an investment comes your way, what you want to be able to do is to understand what should I be looking for, what should I be looking at in order to determine whether this is an appropriate investment for me. And I'm less concerned right now about whether it's appropriate for your particular portfolio. That's a separate conversation. Tomorrow I'm going to be doing a presentation called The Investor's Rules of Engagement. And I'll talk more about the personal component of investing at that time. But what I want your focus to be on today is primarily what is the process by which you underwrite a deal yourselves. What are you looking at when you look at the deal? What are you asking yourself when you're looking at that deal? So that's what I'm going to be talking about, okay? So I put together some slides for you just so that we can actually walk through the process, and this will be the second time that I've seen these slides since I was madly putting them together yesterday before I got on a plane, and we'll now look at it. So I structured it this way. So there are 5 basic areas we're going to look at. We're going to talk about what you looked at, what you're going to be reviewing when you look at the sponsor, what you're going to be reviewing when you take a look at the project, how we look at the structural and legal components, how do you evaluate the financial side of it, and then what do you look at from an investment point of view. Now, in going through all of this, I recognize that your primary focus has not been in this world, in the underwriting world, in investment banking, in analysis and all that kind of thing. So it's not so much that I am suggesting that because of this particular session, you're going to walk out of these expert in this. But there's an opportunity for you to just understand the language of underwriting, what people look at, why they look at those things, why it makes sense to recognize how they're important, and those types of things. You can always rely on experts that give you the opportunity to be able to drill down, as David was talking about earlier. So you might review an expert who's in the accounting side or the legal side or the financial side, but at least you're going to understand from a broad perspective what these issues actually are that you're looking at. So let's take a look first of all at the sponsor. When I'm evaluating a deal, so a deal comes across my desk, or for example, as we're talking about with the deal submissions right now, when you have all of these documents, we call them due diligence materials, due diligence documents, that are coming in with respect to a particular deal which is going to be submitted for the possibility of your investment, as an example. One of the very first things I'm going to be looking at is going to be the sponsor. Who's behind the deal? We're going to talk about what the deal is in a second, and that's what I mean by project, but who's behind the deal, and those types of things related to the sponsor. In the context of that sponsor, almost the very first thing I want to do, before I drill down, I want to get an understanding of the broad perspective. And what that means is, what's the ownership structure of the transaction? When we take a look at an investment which is coming your way, is it owned by an LLC, a limited liability company? Is it a fund? Is it a fund that is actually being managed by a fund manager? Does it have a separate operating advisor? So what's the ownership structure? And within the context of the ownership structure, who are the, and I'm prone to say from time to time, give me the human beings. So I get the entities. All right, now I understand the entities. Where's the flesh and blood behind them? Who is the ultimate controlling person who makes the decisions on a day-by-day basis? So the best way to do that is to take a look at it from the standpoint of the ownership structure, because almost inevitably those people in the ownership who are most involved in the actual ownership, the higher percentages, are going to be the ones who are making the decisions and are going to be the ones that are most appropriately impacted by what the consequences and the outcomes of that particular investment would happen to be. With that, easiest way to do it is give me an organizational chart. I will tell you, by the way, that my approach to this is not unlike my approach to a brand new client. As you know, I represent investors, I represent business people, I represent companies. One of the very first things I always ask them to do is send me an organizational chart so they understand what your organization looks like. Who's on top, who's making the decisions when it comes to marketing, who's making the decisions over there, how do you handle operations? And once I have the organizational chart, much easier way for me to be able to picture how that transpires. Same exact thing in an investment, but even more so. Because in an investment, what happens is you have this thing on a piece of paper, you've probably never met the people. You have an advantage, of course, here because these are coming to you through trusted advisors. And so you have met the people, and that helps a lot. But usually, in an underwriting capacity, what you're seeing is a bunch of paper, and you see entities. And what you really want to be able to see is, give me the what's the organization behind those entities, because they're the ones who are ultimately going to have to operationalize the outcomes that are actually coming from this. Who's your executive management? And of course, once you get executive management, who are the people who are on top? How do you actually divvy up the executive roles? And once you understand that, now most importantly, what's the track record? Have they done these types of deals before? Have they not done these types of deals before? You know, it's interesting. So when I transitioned from technology, which was what I was doing before, I've always been lawyer, I've always been business person. And before that, I ran a pretty substantial sized technology company before I got involved in senior living. But in the context of senior living, when I put together the very first of what we did as far as investment vehicles were concerned, and also just going for lending, institutional lending for our first facility, our first community, we had an executive management team, and it was a pretty pristine executive team. I mean, we were all experienced at what we were experienced at. But except for one person, we weren't experienced at senior living. And so in the context of what we're talking about here, which is underwriting, it's appropriate that you understand what the backgrounds are of the individuals who are involved. And it doesn't necessarily mean that you're going to, I mean, you know, if somebody were not to have taken a gamble in 2011, when I first got involved in senior living, because I had never been in senior living, but they did take a gamble on the fact that while I didn't know senior living, I did understand how to run a company. And so from that standpoint, they were prepared to do it. My point to you is not so much the outcome of your decision, it's the fact that you're just simply asking the question. So when you're asking the question, it's going to be, are you focused on understanding the organizational chart? Do you focus on the executive management team? Because they're the ones who are going to be making the decision with respect to this investment. And then what's their background? Where did they come from? Did they come from real estate? They didn't happen to have this particular category, asset class in real estate, but they understand real estate. Or did they come from a large company? Did they come from a small company? Did they do some rehabs and now they want to be, you know, and I was just thinking about an example now. It turned out to be absolute disaster for the person. I'll forget about that, I'll tell you this one. So this guy, this guy's out west, and you know, he wanted to be a fund manager, and you know, the one thing that he knew how to do is he knew how to sell. He was an incredible insurance salesman. I mean, I remember when I first picked him up as a client, he showed me a presentation and on just simply how he sells, and therefore how he translates. He had done three very small funds. He had done three 504 funds, which are $1 million cap funds, up to that point in time, and he had just sold them out just like that, 3 funds. He was an extraordinary salesperson. He was really, really, really good. Knew nothing about fund management, and he knew nothing about investing, and he knew nothing about the underlying assets that he was investing in, but he was an incredible salesman. And so in the context, and I told him at the time, I said, listen, you really don't have any business being in these assets. Love how good you are. I mean, you will close. Anytime I need somebody to close, to sell, be glad to hire you for it, but you have no business managing these funds without getting somebody in who understands. And it actually got worse because I empowered him by giving him a 506B. So now he had the opportunity to go out and not get limited by 1 million. Now he had the opportunity to go collect 25 million bucks. And the next thing I know, he's going into oil and gas drilling, and he's going into commodities, and he's going into stock market trading and all of that. And the only thing he came from is insurance sales. And that's all he'd ever done was insurance sales prior to that. So when we talk about the background, what I just want you to recognize is the necessity to understand who the principals are. It doesn't mean that it's necessarily going to be, axiomatic. It's going to be canonical. But what I do say is that it is an important consideration for how the outcomes occur, because that background is going to be translated into the decisions that they make every single day, not only with respect to selection of the assets and how they're handled, but also with respect to how you deal with the minutiae of all of the different types of decisions that get made when you're dealing with those particular assets that are part of it. You know, I do actually, I do question and want to be involved in making sure I understand who legal counsel is. And not because I am, you know, I've been a sole proprietor my whole entire career. I've never been a silk stocking lawyer. My son, and I think I mentioned Jordan, who just had his 2L, which is his second to third year program. He is with a company, with a law firm called Ropes and Gray. And talk about, it's a Boston law firm, talk about silk stocking. Let me tell you, this is like 1,000 lawyers. And 1,000 lawyers, they actually wear suits in the office. I mean, it's just like Suits on TV, just in Netflix. I mean, it's kind of like, and I always joked about the fact that, well, how do lawyers don't operate like that? These guys do. So it's like that type of law firm. There's a plus and a minus to that. On the one side, they're very buttoned up, but on the other side, they're extremely rigid. And because of that, there's and talk about billing. I mean, these are, the summer class are the associates that are going to be hired next year, 140 of them. 140, and the average starting is $190,000 a year, right? For a person right out of law school. Now, you're looking at that and you're saying, who's paying for that? Oh, I don't know. Who's paying for that? Of course, they're billing them down to their clients at anywhere from 3 to 4 times the hourly rates, right? So you're paying for it. Obviously, the clients are actually paying for it. So there's not a major, so I'm not suggesting that it's got to be a prestige law firm. I'm just suggesting that the lawyer does have to have competency in whatever the underlying asset class is. And if it's a security, they have to understand securities. Just got involved the other day with a situation. It's a technology product that came my way through a referral. And there's a group, you know, one of them is in Lebanon, the other one is in Canada. They're startup types of people who have come behind this. There's no lawyer involved at all. And it's the question that you asked, right? That was my point. And they now filed a Form D with the SEC. And they've raised about $350,000. There's no PPM. They don't even have bylaws for the company, and it's a Delaware company. And so when I ask the simple question, so who's representing you? The worst of all possible answers, nobody. Nobody's representing us. No securities attorney, no commercial attorney. They're doing this on their own. And it's kind of like, all right, let's hold the horses right now. Let's stop. All right, we'd have to pause. And now I go back 6 feet to make sure, 6 steps behind, that we start from scratch. And I'm now creating the bylaws for them to file at Delaware and producing the documentation that can support the $350,000 of investments they've already brought in and so forth. My point as far as legal counsel is, I'm not asking you necessarily to be judgmental with respect to the legal counsel. Just make sure that the counsel is competent at whatever the assets are and whatever the activities are associated with that particular one. Okay, these are all related to the sponsorship with respect to that particular investments, and best way to manifest what I'm suggesting to you is just ask questions. These are just the questions that you would be asking with respect to the sponsor itself. Okay, anything on that? You good? Okay, let's take a look. Let's talk about the project itself. So now I now know that there's a group of people. They're involved with some type of, you know, what they want to do is they want to build self-storage facilities. And in the process of putting together, say, self-storage facilities, this is the type of investment. Now, what are you going to want to know? Unless you're just an expert at self-storage facilities, I'm not. But doesn't mean that they're not strong. There are some very good. So the first thing you want to know is, what do you know about the industry? So let's understand the industry, first of all. Get your arms around the broad dimensions, the outer boundaries of the industry of self-storage. How does it work? Who are the players in it? How do they function? What's the business model? What's the primary way? What are the metrics that they use? So this is all part of an industry component attached to that. How would it manifest with respect to the due diligence documents which are being given to you as an investor? It's got to be someplace. Now, it can be someplace in the form of the PPM. David mentioned PPM earlier, in the private placement memorandum, And anybody who's worth their weight in salt, is worth their weight in terms of what they're doing, is certainly going to have an industry background, an industry overview inside their PPM materials, because the investor isn't expected to be an expert at that. The person who is putting the deal together is supposed to be the expert. So you'd want to make sure that the industry information is there. But there's only so much information you can put into a PPM. So for example, in our Dropbox, we have a ton of data that are multiple studies from all over the place that talk about senior living industry. We couldn't possibly incorporate all of that into a PPM. It would be outrageous if you tried to do that. But there should be anywhere from a minimum 2 pages to 3 pages, 4 pages of an industry overview to understand how that particular industry actually functions. So too with respect to the asset class. What I generally would want to do, and what I like to see, is an overview of the industry as a whole, and then specifically the particular asset class which is involved. And so if we're talking about real estate and how real estate functions, when you heard Mike and Ryan earlier today, they were talking about the broader dimensions of real estate and where the different entry points are for those, as far as in addition to that, of course, the liquid opportunities that are available in the stock market as well as alternatives. So when you're looking at it, you're looking at the broad dimension, and then you're identifying how they now divvy up with respect to the particular asset classes which are in them. So for example, residential real estate, commercial real estate, self-storage real estate, office buildings, affordable. And in each one of those things, they're really subdivisions. Even in the category of residential, you can categorize residential in terms of what? You can categorize it in terms of luxury, in terms of mid-market, in terms of affordable, and so forth. So you want to just simply understand what I would call, if you will, the taxonomy of the broad industry and of the asset classes, so that we can now focus very specifically on what you would like to focus on, this particular investment which is in front of us to evaluate right now. By understanding the broad dimension, you can now understand better what the particular dimension is. You also want to understand the market that's being served. Who are we actually going after? Because, and how that manifests, of course, almost all the time, is going to be, as you notice in the very bottom, a market study of some type. So we have, for example, and I use examples from what we're doing only because it's fresh in my mind and so forth. But clearly we understand the market that we're serving. Senior living, for example, has a broad dimension. It could be independent living, it could be assisted living, memory care, enhanced assisted living, and so forth. So you have different categories, but we're very clear with respect to the broad dimension. We are up at 25% quartile. So we know the demographic that we're after. And so the market studies that we would be integrating into our materials are market studies which are focused very specifically on that particular upper 25% quartile. So we know the income, what that looks like, the average income. We know what the primary assets are, the household, the primary residential value of that particular, and how many of them there are that are not being served. That's a very typical market study, and you would expect that with respect to any of these materials that are being submitted, for example, in our submission for IRC, you would expect a market study to be there, because you're not expected to know. What we're doing is we're doing self-storage units in St. Louis, Missouri. Okay, so tell me a little bit about how do self-storage units come in the picture with respect to real estate in general, and with respect to self-storage units, what are the KPIs, what are the indicators as to how they function, how do they make their money, where does their net profit come from, and so forth and so on. How do they capitalize on exits and things of that nature, okay? In addition to that, let's talk about St. Louis. Let's understand what the particular market segment is that you're serving. And in the context of St. Louis, do you have a market study to show us what it looks like in St. Louis, that there's an actual opening available for self-storage units in the St. Louis area? So you're just simply drilling down to the particular market that's being served in that particular context. You're also looking for what your strategy is. What's the strategy that you're going to, what is it about this investment which is particularly special? And how are you going to be implementing that particular strategy? You know what? It's not that I'm trying to avoid deals that are currently being evaluated, by the way. That's why I'm stretching for additional ones, because I don't want to incorporate the ones that are being evaluated. But you know, so I'm thinking sort of past ones. Okay, so past one I did. So you know, we're talking about a particular person who was going into Oregon. And in the downtown areas in Oregon, there are a lot of old buildings in this particular town. And he was going to be focusing not only on the historical properties that were in Oregon for the purpose of renovating and remodeling them, but on top of that, they all happened to be owned by the city itself, that they had taken over time. Okay, so what I just delineated for you is a particular strategy. What's the advantage? What's the particular advantage? Well, number one, I know this particular city. I'm well connected to the principals, the mayor and so forth, this particular city. I'm focused on historical properties and renovations. I know I'm going to get tax benefits on a federal level. I'm also going to get tax benefits on. So what I just described to you is a particular strategy. What is your strategy? What is your business plan? What makes it different? Tomorrow, when we talk about the sort of rules of engagement with respect to investors, what I'm going to be suggesting to you is that a business, an investment, is nothing other than a business. You know, if it doesn't work as a business, it's not going to work as an investment, obviously, right? And so no business has a success opportunity unless it's got some type of differentiator, some type of strat plan behind it as to why it should be successful. So if an investment doesn't have that, it's certainly not going to be successful. So your evaluation in terms of evaluating the project is to just simply understand what is that business plan that's going to be supporting this particular investment at this time. And then finally, you know, the marketing materials I threw in there because when you do have marketing materials, it's helpful. I was evaluating a particular tech product that was being directed to seniors, and you know, brilliant guy, very successful entrepreneur. He sold his company for, you know, $10–12 million and sat out for a little bit. Now he was back into it again, but man, he had the toughest time explaining his product, and he was raising seed capital for it. And so I finally just simply said, do you have marketing materials that you've developed for your product? And he said, yeah, you know, we have a marketing agency that does that for, can I just see your marketing materials? You know, because I obviously can't figure out what in the world you're talking about, man. So just show me the marketing materials. And I saw the marketing materials and it was like, cool product. This is really, you know, I can't imagine why you can't explain it, but this is a really cool product, right? So I threw that in there precisely because of this one guy. The marketing materials went a whole lot farther in explaining what his product was than he was able to explain in his product. But it's helpful. It's helpful because it combines good solid copy from a marketing copywriter with good solid graphics from a marketing graphic artist into a way which communicates to consumers. So the marketing materials are helpful in that regard also. But in any event, these are all related to the project itself. Final comment that I did want to go into, though, project key features. With respect to the project key features, you can get very much tied in to the details of the investment, and you know, you might lose your way. So it's always appropriate when you're taking a look at the project that I talk about recaps. Okay, so let's recap. Let me just understand it from a recap standpoint. And if I need more than 5 fingers, then it's probably too complex to deal with, right? It's kind of like, okay, what you have found is you have found a particular niche in the St. Louis area that relates to self-storage facilities, primarily because of the fact that there was an ordinance that prohibited self-storage facilities, and they're now just beginning to catch up. That gives you the opportunity to be able to develop those in the next 24 months to receive a higher than average rate of return on that particular investment. Is that a fair synopsis of what we're talking about? Yes, thank you very much. If I've got what is fundamentally, when I now extract myself from all of that, what are the fundamental key features of this particular investment? If I capture that, then I'm going to be able to process more effectively whether the assumptions are actually appropriate assumptions to even be making. And particularly because those assumptions have to be valid for the rest of the stuff to actually occur. Let's take a look at some more. Let's talk a little bit about the structural and legal stuff. My first comment with respect to that, regulatory exposure and compliance. Every business has some exposure, right? Every business has some implication with respect to a regulatory component attached to it. For example, one of the comments that I've made, I've heard when people talk about senior living, is they talk about all of the regulatory stuff related to it. And yes, there is some regulatory, but we're not government funded, so we don't take Medicaid, and we're 100% private pay. So within that context, is there regulatory exposure? There's some. Obviously, seniors, you need to take care of seniors. But at the same time, we don't have the same type of exposure that you would have if you were a nursing home, if you were what's known as a skilled nursing facility. So that exposure, though, is the first kind of question that you ask. So who are your, and how does it manifest? Who are your regulatory bodies? Who do you report to? There are some businesses, I have done an awful lot of business in the information processing, information marketing. Masterminds would be considered to be one category of that. We ran institutes for years and years and years. And we had to be very careful in lots of categories. We did private mortgages, National Mortgage Investors Institute, factoring, International Factoring Institute, and just a whole host more. There were two primary regulatory bodies which were very, very serious. The FTC, Federal Trade Commission. I think Facebook has heard something about that company, that organization recently. And then you also have the state attorney generals. And those are your primary regulatory bodies. And is it considered to be a regulatory risk if you're in the information processing field and information marketing field? Absolutely. FTC and state attorney generals can shut you down, not only including what all other kinds of things they could do, like fines and penalties and making your life miserable for a very, very long time, and so forth and so on. So that would be the regulatory exposure that you would be evaluating. So your question in this particular consideration, if you will, of the due diligence materials is where are your regulators? Who do you report to? For somebody in broker-dealers, for example, obviously they have two primary ones. They have the SEC on the one side. In the securities world that we've talked about, you have the SEC. You also, on the federal level, you also have the state securities for each of the individual states. And then you have FINRA, if you happen to be a regulatory or regulated or licensed body. So those are your regulators. So question one more time is just simply the question that says, who are you regulate? Who do you report to? Who do you have to file your reports with so that you understand better what their exposure to any type of regulatory environment is? With respect to the offering documents, I've seen due diligence materials that are not clear with respect to what the actual thing is. I just mentioned this client that I just picked up this past week. They're actually taking, and I mentioned $350,000 plus they've got money coming in transition. There is no subscription agreement. There's no PPM. There's nothing. There's just simply the hype about the fact that this particular, it's a mobile app. Of course, it's technology, right? Because everybody gets real excited about technology because it's going to be $1 billion product, obviously, right? So they start cutting checks, and they start cutting checks without a PPM and without a subscription agreement. So they don't even know what they just bought. They don't have a clue as to what they just invested in. So, and the valuations are just plain silly. But so with respect to it, when we talk about the offering documents, you wouldn't even consider. And when you take a look at, for example, going into the deal room that Freedom Founders has set up for you, you go to the deal room, I mean, you wouldn't even consider, of course, it wouldn't even be there if it didn't, but you wouldn't even consider in your lives invest in anything that doesn't have appropriate offering documents. Offering documents at a very bare minimum are going to be the PPM itself, the private placement memorandum. Some people call it in some states an offering circular, but it's one and the same thing. It's just simply a document that identifies all of those things that I just described. Here's the investment, here's who we are, here's where we came from, here are your risks, here are the things you want to think about, here's what the investment is going to look like, so forth and so on. And while I understand, and David made the comment earlier, I mean, who sits around reading PPMs? How about this? How about just be satisfied that there is a PPM? That's the helpful part. It's kind of like, can I see your PPM? And it's kind of like, what's that? And you have a problem, right, at that point, right? The second thing that is important is the subscription agreement. And the reason the subscription agreement is important is because it is your relationship as an investor to the sponsor who is offering the investment. And absent that subscription agreement, that is that relationship, that contractual relationship between the two, you don't even know what you're buying. You don't know what you're investing in. So you have to be able to take a look at that subscription agreement because it's going to identify the thing that you're going to be investing in as an investor, and more specifically, what they're going to be giving you. So for example, a subscription agreement might be for units in a limited liability company, an LLC, or it could be a promissory note. It could actually be a debt obligation. And then the question becomes, okay, so is that subscription agreement the debt obligation? If it is, let's see the terms. And if it's not, where is the debt obligation? There's a separate document over here. What's that? Oh, it's a promissory note. Can I see it? Okay, I appreciate it if I could see it. There was one, by the way, that did not make it through the IRC process. And the fundamental problems, is this a good time to talk about it? Yeah, why not? Well, I could talk about it in terms of remedies later, but I'll just mention it now. The fundamental problem was exactly what I just described to you. What it was a debt instrument. And the problem with the debt instrument is that every investor, one of the many problems with this particular debt instrument is that every investor was going to be signing a promissory note. Well, they would sign a promissory note to the investor, of course. And every single one of those was a separate entity, not an entity, a separate promissory note instrument. And what it did is, because of the fact that there was no one investor who had any rights with any other investor, if there were a default, that individual investor was going to have to pursue their own remedies in terms of going after the sponsor because of that particular default. There were no attorney's fees in the promissory note itself, which means that that investor who's in Kansas, who is investing in this thing that I don't remember where it was, Oklahoma, would have to in some way chase the sponsor in Oklahoma without any possibility, even if successful, at collecting attorney's fees in the process, which makes it very difficult when you go to an attorney and say, hey, these guys haven't paid me. And you say, okay, can I do something about it? Sure, I can sue them. That's the good news, I can sue them. Let me tell you all of the bad news. The bad news is, number one, my retainer is. Number two, the cost of this is. Number three, I get a judgment. Number four, what do I collect from that judgment, and so forth and so on. So it didn't make it through because, and by the way, there were several others. They had 6 silly, quarterly payments. And in addition to quarterly payments, it was an additional 90 days right to cure. So it's like you could be 6 months without receiving a payment before you could even file a suit. It was just silliness. And so we said, listen, we can't do this way. If you want to correct it, you can certainly rehab this thing. And they just weren't willing to do that, so it never made it into the final IRC. And so from that standpoint, it's gone. But my point to you in terms of this context is you would not have seen all that without seeing the promissory note. And so it was only when I insisted on seeing the underlying promissory note itself that I see all that. And then once I saw the promissory note, it was kind of like, okay, but no. I mean, it's not, no, it doesn't make any sense from that standpoint. So where would the promissory note manifest itself? Well, the PPM is going to identify the structure of the deal. There's going to then have to be some relationship back to the company from you. That's called the subscription agreement. And in this particular case, a promissory note, because it turned out to be the debt instrument itself. In other words, a debt isn't self-effectuating. It doesn't just happen on its own. Something has to happen in order to create the debt. And so the document that creates the debt, in this case, was the promissory note. And then once you read the promissory note, you realize this is not something that you're going to want to touch. And of course, this was not something that we were prepared to bring into the team. Organizational documents. Shareholders and operating agreement are really part of the organizational documents. I have it under offering in terms of the actual offering documents because they tend to be attached to the PPM as exhibits. But at the end of the day, they're one of the organizational documents. I made the comment to you about this client this past week that I picked up. And in the process of doing that, what happened is I looked at it because these other two people that were involved in it that were raising this 350, I had no idea where they came from, so my first question was, where are the bylaws? And there were no bylaws. So in effect, what happens when there are no bylaws is they're doing everything that they're doing and they have no corporate control over how to do it. That would be considered an organizational document. So what are you looking for in organizational documents? You're looking for, of course, the articles of formation. Companies get created, and so that's called articles of formation in the process of doing that. Number two, what you have is bylaws. You also have shareholders' agreements or operating agreements, depending upon what type of entity they are, and so forth and so on. So these would be organizational documents. Again, I'm not asking you to be reading these organizational documents. What I'm asking you to be aware of is they have to exist. And if they don't exist, bad things happen and bad outcomes occur. So you just want to make sure that they actually exist in this. And then there's nothing better. We always incorporate a chart into our PPMs. There's nothing better than a diagram of the related entity and the project structure. Because once you understand how it works together, you have a much better picture of how it's going to operationalize. And by the way, I have no idea how much time I have.
17 seconds.
Oh, I see. All right, well, let me talk really quickly then. Okay. I'm a lawyer. I'm used to talking a long time, so, okay. That's the one thing. Judges never stop you. That you can keep talking as long as you want here, and you build by the word. So in any event, this is all financial modeling. And here are the two components of this. That's all I want to say, and I'll make this fast. It either exists, in other words, it's already an operating entity, and if it's an operating entity, then there's data that show you how it's doing. Or, in the alternative, it's a projected process, and there's nothing wrong with that. You have to start someplace, right? So it's projected, in which case there are forecasts and pro formas. The important part between the two is if you've got the data, you got the data, that's fantastic. And if you want to take a look at the data, if you don't have the data, it's projected, then what you want to do is you really want to understand what the assumptions are. Because forecasts don't occur by themselves. Forecasts occur only based on the assumptions that are being made. And so if I believe that there are 10,000 unserved elderly in my demographic in this particular city, that's fine, but what's the assumption as to what percentage of those I'm going to get? And is there validation for that assumption, and where does that validation come from? So I'm only suggesting to you, financials, look at the financials, and if it's projected, perfectly okay, but look at the assumptions on which those financials emanate from. Then you have the investment itself. So what am I investing in? How much of that is deferred, and what's the targeted return? How much is the current? How much is the deferred component of that? I want to understand what's the method of investment, and then that's where I talk about the reporting and the default remedies. When am I going to be getting a check? What happens if I don't? And what are my rights if I don't? And I want to make sure that I understand that, because that's going to determine what happens if I'm a very unhappy camper the first time I don't get the check that I thought I was supposed to be getting. Okay, and then I think, let me see what else. Yeah, let me just simply show you how that manifests. I'm going to show you one because it made it through the review committee. And so what ends up happening is we end up with, this happened to be, and I think and this was Rob I was just going to say, so that's your deal, that's Rob's deal. And I just have to tell you, by the way, it was a pleasure. It was a pleasure to take a look at this deal, because the one that I had just described was the one immediately before, when it was that promissory note that didn't have any, and it was just like 3-month cure period. It was ridiculous. The whole thing was ridiculous. And then I saw Rob's, and it was just like a delight to be able to see. It was well put together. It was structured properly, exactly the way it was supposed to be. So what we do is, one of my partners and I, we provide what we call a negative assurance letter. Negative assurance letter is not, by the way, a letter that says to you, invest in this fund. That's not my decision to make. A negative assurance letter says there is no reason to believe that there's anything in this investment which is not market clearing. It's market clearing. That's all. That's my job, is to just simply tell you that it's market clearing. There's nothing weird about it. The fees are within range. The structure is within range. The documentation is within range. That there's nothing here that would pause and be concerned. So it's not a positive assurance, which says invest. It's a negative assurance, which says there's no reason to believe that there's anything here from which you should not invest. Okay? So you get that letter, and that just happens to be signed by both myself and one of my partners, Bill Johnston, who's in charge of our financial advisory practice group. And then it's supported by the actual analysis. And the actual analysis consists of all of that financial stuff that I would not in a million years try to bore you with here, since I already went out of my 17 seconds 5 minutes ago. But just simply by virtue of the fact that we provide this actual analysis, I think Mike had talked about, for example, debt coverage ratios, cash on hand, all of those different types of analyses, which we would actually be doing in order to determine that a negative assurance is actually appropriate. So we submit this as part of ours, and this is, for example, in indicating the fees that they were taking are certainly within range with respect to this particular type of asset class and particular type of risk-reward ratio, like that. So in any event, here, my whole purpose in talking about this was this was not a nitty-gritty class, in which case it would take all day, but it was just simply an overview of what the underwriting process is really all about, so that when people talk to you at this point, have you had that deal underwritten, you know what they're talking about. They're talking about, did you have somebody evaluate it, the sponsor, the project, does it make sense? Are the financials supporting it? Is the investment cogent? Is the documentation appropriate so that you get what you're actually looking for? Okay? Any questions at all? You otherwise okay?
They got it all, I can tell.
Thank you very much.